Good afternoon, everybody, and welcome along to this Scottish Fiscal Commission presentation. So I'm Graham Roy, and I'm chair of the Commission, and we're here today to give you an update on the three publications that we published yesterday: our forecast evaluation report, our statement of data needs, and also our annual fiscal update. The format of the webinar will be the same as usual, in that what we want to do is run through with you some of the key insights and key work that we think is interesting, and we'll do that through a short presentation, and then we'll move into questions. And for questions, we'll use Slido, and you can see the code for Slido on the bottom of the screen here. If you type in that code, that will take you through to the Slido page, and please do feel free to put in your questions. There's a chance as well to vote for questions to prioritise them. And we will do our best to get around as many questions as we can. So I'm delighted to also be joined by my fellow Commissioner, Eleanor Ryan, who will shortly guide us through the presentation. And we're also joined by Claire Murdoch and David Stone from the team, who are on hand to pick up any technical questions that we might have as we go through this. So Eleanor, could I hand over to you and to kick us off through the presentation, please?
Thanks very much, Graham. Hello, everyone. So we have published three new reports yesterday: our fiscal update, our forecast evaluation report, and our statement of data needs. There's been a slightly longer gap this time since we did our forecasts in January, and we've had a longer gap due to the election timing this year. So you would normally have heard something from us perhaps in May or June. So I'll take you through. We're going to spend most of our time talking about the fiscal update because that's got a lot of the substantive items, but obviously our forecast evaluation report, looking at how we performed, and our statement of data needs, looking at the data that we want to continue to improve our forecasting and commentary, are also important. So I'll start with the fiscal update on economic outlook. When we were forecasting in January, we've focused on this slide on inflation, which is one of been the big issues. Obviously, we had that very high period of inflation when due to the Russian invasion of Ukraine and the spike in energy prices. And inflation has remained relatively high, but we were forecasting in January that it would come back down towards around 2% by the beginning of 2027. But the latest, obviously many things have happened since then, not least the Middle East conflict. And the Bank of England's central forecast in July was suggesting that inflation was going to remain higher, and this continues to be quite a difficult economic outlook with, as we have been saying for a number of years, a lot of uncertainties. Just one particular feature of that. So obviously we have looked at economic growth, but particular way that we talk about economic growth is looking at really the personal impact of that, and we look at living standards through one measure, which is the growth in the real disposable income per person. And this chart shows that between 1999-2000, basically devolution time, and 2007-8, when the global financial crisis hit, real disposable income per person in Scotland was growing at close to 3% on average per year. And since 2008-9 and up to 2024-25, we saw an average of under 1%. And the outlook here is showing that it remains very low in 25-26, and that we're not expecting to get back up above 1% growth, which will mean that household budgets will continue to feel quite tight. And a thing that is hidden really in this chart is that the real disposable income growth is not even across household income groups. We don't currently have data in Scotland which allows us to break it down, but there is GB level data, and there's no which shows that at GB level, the lowest decile, the lowest 10% of households in income terms are have suffered, and in fact have seen a real terms cut in disposable income per person. And there's no reason to suppose that the pattern in Scotland would be radically different. We would expect this to be hitting hardest on the lowest income groups. And given that a lot of the inflationary pressures that we were talking about on the previous slide are around fuel prices and food prices, those things do tend to hit hardest on low income groups. So very challenging economic outlook, and the way that will be feeling will be potentially quite tight across the board, but really very challenging for low income households. Turning to looking at the government funding position, this is the latest position on the current financial year. So we're focusing here mainly, well, we show the other sources, but we're talking mainly about the block grant, because the block grant continues to be the biggest driver of the funding available to Scottish Government, Scottish Parliament. So since January, when we set out the funding position, there has been an additional 625 million of resource funding on the block grant, and a cut of 63 million on the capital block grant. Now, those are driven by two main changes that the UK government has announced. The special educational needs package that was introduced at UK level, or for England, has had consequences through Barnet for Scotland, which means an additional revenue in 26-27, but that money does not roll forward into future years. So there's a particular challenge around that. The cut in the capital block grant is mainly a consequence of the Defence Investment Plan, which has seen cuts of across capital spending on equivalents to devolved matters to channel it into defence, which of course is a reserved matter, and there's no Barnett consequentials on defence spending. There's still a significant uncertainty around that, because there's still a large amount of money in the Defence Investment Plan where the UK government have not said exactly where it's coming from. So that's an uncertainty, particularly around capital, until we see what happens in the UK budget on the 28th of October. There are some other things. So looking back at resource, the Scottish Government have announced an additional 162 million through the Scotland Reserve, mainly due to higher than expected underspend for 25-26. And there have been some other small changes as well. And again, there's a bit on the Scotland Reserve on the capital side, again, through underspending. And then the other changes include things like Crown Estate revenues and various other sources that are available to Scottish Government. So overall, it looks as though 26-27, there's quite substantial additional funding available. But there are some challenges around that, because as you start to look at the trajectory of the spending. So we'll do that next. So again, this focuses entirely on the block grant. So what we're showing here is what has been happening in recent years and the forward year trajectory around the resource and the capital block grants. And we're showing it indexed to financial year 2022-23. And these are real terms figures. So look at the real terms growth between 22-23 and 2030-31 is really very small. It's about 8% or so in real terms over all those years. And in capital, we're seeing a real terms cut over that period. It dropped sharply to 24, 25, and then there were increases, but it's falling again in real terms. And this makes it quite a challenging outlook for the government to manage. It's not quite so obvious in the figures that we put up here, but you will see that there is a dip from 26, 27 into 27, 28 on the resource side. And we mentioned that the additional money coming through in 26, 27 creates a potential problem when you get to 27, 28. In fact, there are other factors that will negatively impact on 27, 28, including income tax reconciliation, which I'm coming on to talk about. So it will be really important for the government to think about its admittedly limited, but all the different ways, flexibilities that it has to allow it to manage its money and to smooth out the profile across years. There is the Scotland Reserve. There is, on the capital side, there's the borrowing, there are Crown Estate revenues, there's non-domestic rates pool. The government needs to be thinking about and setting out in its budget how it is going to handle these fluctuations across years. And I mentioned that the income tax reconciliation, the outturn for 24-25 has come through, and there is a negative reconciliation in 27-28. So let's talk about that for a moment. So you'll probably remember the way that all the tax funding works, but particularly income tax because it's so big. At the time of the budget, we forecast what the income tax revenues will be for that financial year in Scotland. And there is a calculation of a block grant adjustment. So an amount that is deducted from the block grant is calculated based on OBR forecasts for UK. So we deduct an amount that is what effectively the tax foregone by the UK government, and then add back the forecast of the income tax in Scotland. And income tax takes quite a while before we get through to a final outturn for it. And so there's a reconciliation down the line, which then adjusts for the final numbers that come through compared to the forecasts. And what we show in this chart is the ways that the reconciliations have gone in recent years. So the purple bars are the differences between the forecast BGA and the outturn BGA. These are based on OBR numbers. And then the green bars are the difference between the SFC's forecast and the outturn. And you'll see that in a lot of years, or in the past 4 years, the BGA error and our forecast error have tended to go in different directions, and so they partially cancel each other out. And there's nothing surprising about that. Two different bodies are trying to forecast. It wouldn't be surprising that we might be wrong in the same direction. So because the BGA is negative, if you see the bars here going in different directions, that's because we and the OBR were effectively out in the same way. But this time, for 2024-25, although our Scottish income tax revenue forecast was in fact most accurate that we've had, the reconciliation is in fact the largest that we have had, or the largest negative one that we have had. And that's because, as it has turned out, the two errors add together rather than partially cancelling each other out. And that leads to £720 million, which then has to be found from the Scottish budget. Because the Scottish budget has already benefited from that money earlier, it's got to be repaid. And so we don't know the final figure for the borrowing limit because there's an inflation element, but it's very, very likely that the 720 million will exceed the Scottish Government's resource borrowing limit. So there will be some in-year negative impact in 27-28, and then the government can decide how much of the borrowing it wants to use and how else it wants to try to smooth out. But that's hitting in 27-28, which was already the year that you'll remember was looking quite challenging from the trajectory of the block grant. So carrying on the funding outlook, just a little more about income tax. So we have been focusing for some time on what we have called the tax-based performance gap. So if you look at the amounts, if you look at just a theoretical calculation of how much income tax would be due if the Scottish tax base performed exactly in the same way as the UK income tax base. So if in Scotland all the economic factors, the employment levels, wage increases, so on, all came together in the same way as at the UK level, and nothing else changed, the policy-only income tax net position is how much additional income tax might be raised in Scotland just due to the changes in the tax thresholds and rates. And then the column that says income tax net position is how much, in fact, was raised in those years. And we've been focusing on the difference between those two, which is the tax-based performance gap. And you can see that that it was quite a big difference. So let's look at 24-25 because that's the most recent year. So we had just shy of 1.6 billion as the policy only net position and around 0.7 of a billion as the outturn. So this tax-based performance gap of 888 million is a big deal, and we've shown the percentages that we've shown that as a percentage of the total Scottish income tax revenue, and it's been running along at 4.5% or so with a blip in 23-24. There has been a bit of interest in the top rate and the behavioural effects and the Laffer curve and whether Scotland may or may not have fallen over the top of the Laffer curve. And I mean, our view is that it's not possible to disentangle that and to say with any certainty. But I think what we would say is that that may or may not be an issue, but the bigger issue is looking at what's going on in the overall tax-based performance. The big factors here have been slower growth in average earnings, slower growth in employment than in the UK as a whole, and that's a very big deal because that's having a big impact on the Scottish budget. But note that regardless, the income tax net position is still positive, so more money is still coming into to fund public services in Scotland as a result of the income tax policy. Also looking at the spending outlook, it's important to just think about the announcements that Scottish Government made back in January around efficiency savings. So there's been a lot of discussion and focus on the budget gap projected forward, and what Scottish Government has done is set out over the 3 years that were spending review years how it is planning to deliver efficiency savings that are effectively the things that are helping to fill that gap over those years. And the total value here is around 1.5 billion across the 3 years, so it's a lot. There are workforce savings, that's the little red bars here. There is a very large proportion of this which is due to come from NHS boards, and then there's a whole range of other efficiencies to be managed across public services and public bodies. The delivery of these, so it's one thing to set out the plans, it's quite another thing to deliver these. We are not underestimating the difficulty for the government and for public services in delivering all of this. Audit Scotland have commented on NHS boards' past performance around recurrent savings and the scale in which the scale of savings that are deliverable, particularly for the territorial boards. And the workforce reductions, while not enormous proportions of the workforce, it is quite a challenge to make that happen. So we would be looking for the government to provide a good update to Parliament and to the public at the time of the well, certainly by the time of the budget and hopefully sooner, on how it's getting on and what progress is being made, particularly on the 26-27 figures here. I'd like to say just a little more about the workforce. So in order to meet the targets around workforce savings, the government needs to deliver on average around about a 0.5% reduction in the workforce in each year up to 2029-30. That's averaged over the years. And 0.5% doesn't maybe sound very high, because in any given year you always have some turnover in your workforce. But there are commitments also around protecting frontline services, which means that the impact may be higher in other areas. So there's quite a lot going on here, and we have here some outturn figures. So these are quarter by quarter figures through 25-26 for the devolved public sector workforce. And so we started at just shy of 470,000, and although there was a fall, by the end of 25-26, the devolved public sector workforce had in fact increased. And the purple square shows you, just as an illustration, what a 0.5% reduction would have looked like. So there's a gap there. As I said, the government's target is across the years, so this is not a one-year target that they had, but just to be aware that in fact the challenge for the later years has increased, because by the end of 25-26 there was a gap compared to where they would have been if they'd been on a linear track to meet that target. So there's further work to do on the workforce, and of course there is pay pressure as well. So there were 3-year pay deals set out. We're in year 2 now of a 3-year pay policy. And under that 3-year pay policy, the overall pay award was capped across the 3 years at 9%. But a lot of big workforce groups, including NHS, have deals for 2 years, which have left relatively little headroom, or only a little over 1% left. And given the outlook for inflation, in 27-28, there is a challenge around whether the government is going to have below inflation level pay deals, or whether in fact it will have to breach that pay policy, which will put an additional pressure on the budget. And therefore, if so, what does that mean? How is that going to be managed? Will they have to revisit, for instance, workforce reduction targets? So that was all about the fiscal update. Moving on to talk about our forecast evaluation report. We publish all the figures in much more detail in the report, but here are some headlines around what we forecast for GDP growth, income tax revenue, devolved tax revenue, and then spending on devolved social security. Overall, given all the uncertainties, we think our forecast errors were reasonable. Obviously, GDP turned out rather lower, but there have, as we said, there have been a lot of economic uncertainties to cope with. Our income tax revenue was the smallest relative error we've ever had. Our devolved tax revenue also was very close. Devolved social security, the actual spending was about 3% below our forecast, which is a larger error than we've had. And it was also the first time that the caseload, the number of new cases for adult disability payment, was below our forecast. So we're reflecting on that, speaking to Social Security Scotland and thinking about what that might mean for future forecasts. And then finally, on the statement of data needs, I think it's important to acknowledge that a lot of progress has been made since the Fiscal Commission published its first statement of data needs in 2018. And in particular, Scottish Government has introduced a lot of changes to increase the transparency of figures and to give more information, more and better presented information to help Parliament and help the public understand what's going on in the budget. We have, as you would expect, all organisations in our position always ask for more data. We always want more data. We have 24 recommendations on future data needs, which include continuing to improve the transparency of budget figures and allowing really accurate year-on-year comparisons. So that's the final headlines around our publications. So I'm going to hand back to Graham, and we can move on to questions. Thank you.
Excellent. Thanks, Eleanor, for that. Could you just hold that slide there, just while we've got it, just so that people on the call can take a look again at the Slido code. As we said, what we'll do is we'll spend about half an hour or so just going through the questions that you have, and if you can please enter them through Slido. So you'll see the Slido code on the bottom of Eleanor's slide there. So if you go onto Slido, type in that code, and that'll take you through to the Fiscal Commission page for this webinar, and that gives you a chance to put in place your question. So Eleanor, we might keep that there just for about another minute.
Yeah, no problem.
Jump straight into questions if that's okay. We'll try and divide some of these up as we go. I'll give you all the hard ones and the difficult ones and the easy ones. But there's a really good question there about, and you touched on this, about the potential for the government's and the reconciliation being ahead of the government's borrowing limits on the resource side for 27-28. Could you maybe just explain a bit more about what the options the government might have in a situation where it can't borrow for the full amount of the reconciliation?
Sorry, do you want me to take that?
Yes,
yeah, sure.
Yeah, great.
Of course. So I think we don't know exactly what the borrowing limit will be, but I understand the projection is around 670 million, and the reconciliation is around 720 million, is 720 million. So they might have around 50 million or so to find. So borrowing, of course, only smooths it over years. It doesn't make the problem go away, but it does allow it to be spread out a little. All other things being equal, that £50 million will have to be found somehow out of the funding for 2027-28. So mentioned all the various flexibilities, Crown Estates revenues, reserve, so on. Scottish Government can plan now to think about how, not only how does it want to manage money across years within the limits that are available for these flexibilities, but also how it will manage to have the money to meet any additional reconciliation cost.
Great. Okay, thanks, Eleanor. So there's a question I'll take, which is just about, why did the SSC make an error in the opposite direction to the OBR and compounding the income tax reconciliation? So it's a really good question, and as Eleanor explained, this time the way the reconciliations and the forecast errors work was quite unusual in the sense that typically what we've seen is where we've made an underestimate of Scottish income tax revenues, the OBR have made an underestimate of income tax revenues in the rest of the UK, and that's maybe because largely there's big macro trends that are driving things, and we didn't forecast them, or they've overachieved or underachieved relative to that, and both has happened at the same time. This one was quite unique in that it have been asymmetric, in that we've we overestimated forecast, we over forecast, and the OBR under forecast. I mean, the one thing I would say is that, and as Eleanor highlighted in the chart, we're dealing with exceptionally small numbers alongside very big numbers. So our forecast error of around about 200 million, so just over 200 million for 24-25, compares to an income tax forecast of over 18,000 million. So that kind of difference is really small in the context, but the fact that they kind of went against each other in the forecast meant that that's why it's had a bigger reconciliation just now. So I think again it's one of these things where I think as we become more mature around fiscal devolution, that these are the sorts of things that as we see these instances emerging, the obvious questions are, well, how resilient is the fiscal framework? How much tools do government have in order to manage this? And that gets into questions about fiscal framework, how it operates, and that will be reviewed in 2028. So this is an unusual one that the forecasts have gone in this particular way, but we're dealing with very, very small numbers. It's the fact that they have come together that has made it into this very large reconciliation. Eleanor, there's a question here, maybe come to you now, just about are the Scottish Government likely to deliver the efficiency and workforce reduction plans? Because you touched on this about where trends were, and then the follow-up, which is what are the potential consequences of not doing not following through on the commitments that they've made.
So we don't have any information on which to judge. I mean, other than what we've shared with you. So we've seen the workforce figures. So we can't really say whether they're likely to deliver their efficiency and workforce reduction plans or not. We can say it's very challenging, and we're looking forward to hearing an update from the government on how that is going beyond just those workforce figures that were 25-26. That is all that we have really seen. The political consequences of doing so, well, let's talk about the fiscal consequences of doing so. So the spending review numbers that were set out in January, we strongly welcomed the fact that the government was setting out 3-year plans, because it's been a number of years since that's been the case, and that certainty in spending plans is really important to allow public services to manage and to plan and even to deliver efficiencies, because once you know what your spending trajectory is, you can plan so much better. I think the risk would be that if you can't deliver on the efficiency and the workforce reduction plans that are kind of built into these spending review numbers, then that certainty starts to break down, and I think you might need to revisit spending plans. You might need to reopen various things, and that's again. We've highlighted the government's dealing with uncertainty on a number of fronts, but what it's trying to do is give certainty, or as much certainty as it can, to its public services to allow them to really make good use of the money.
Yeah. And I think that's why we just say that it's really important for parliamentary scrutiny and engagement with the public is just really transparent about this. So where are we in terms of meeting these commitments? If we've made these commitments, great. Where are the savings being made? But if not, what are the potential implications of having to revisit that or plan to do things differently? And this is really difficult for government to do with the uncertainty there, but it's absolutely crucial in order to deliver the outcomes that we see evidence of these efficiency savings underpinning the spending plans. So there's a particular question there about inflation. I'll maybe take Eleanor just about last week's increase in inflation, up from about 2.5%, 2.6%, I think, in June, up to 2.9% in July, and what are the kind of implications around all of that? So I think as Eleanor said, in that chart that we had of the outlook for inflation, if you saw what we were projecting along with the Bank of England toward the end of this year, that there was a downward trend for inflation to come back towards target of 2%. And now what the Bank of England are saying is that actually, rather than trend downwards, is going to start to spike up again and then start to come down toward the later part of the forecast horizon. And that's essentially, predicting and observing what came through the data last week, where we saw this, rather than continue to decline towards 2%, it was going back up towards 3%. And that's just the effects of the crisis in the Middle East feeding through the supply chains, coming through to day-to-day inflation. And I think that the concerns that that has, obviously, from a fiscal perspective at an aggregate level, is clearly it puts potential pressure on borrowing costs at the UK level. So depending what the Bank of England do, that may have implications for borrowing costs, which in turn increase the potential borrowing costs for the UK government, which in turn potentially have constraints on them in meeting their fiscal rules and the like. Governments are also just like us in the sense that the cost of doing things becomes more expensive when you have higher inflation, and that means that the real spending power of inflation goes down. And as Eleanor also alluded to, it's got a particular direct link in the Scottish budget through the pay awards for the public sector. And with over half of the Scottish Government resource budget being tied to pay, anything that you do on pay has a more material impact on the overall spending envelope you've got left than any other aspect of the budget. So all of these things just add up to a mix where the effects of inflation are quite tricky for governments to deal with. So I guess the hope will be is that the spike in inflation is largely temporary and starts to trend down to back towards the target, rather than gets baked into pay negotiations and increased costs of businesses that then potentially make that more stubborn to come through. So I'm maybe just going to give, there's a question here, a more technical question, Ellen, if that's okay. I'll come to you about the decision by the Scottish Government not to produce an update to the medium-term financial strategy this year. Just to be clear, there was a technical reason for that, and the technical reason was an election. So it was kind of came crashing into the middle of when the government would normally have published it. But if we can set that aside, I mean, I guess maybe it'd be quite helpful maybe just to explain about why the medium-term financial strategy is so important and so useful, but then also then feed that through into any kind of decisions or any gaps in our knowledge that we have as a result of the delay.
Okay, so I mean, the medium-term financial strategy is a really important part of the government's transparency to the public, to everybody about the trajectories of public finances. From that point of view, if you're looking over multiple years, you might say, well, does not producing it in any one year matter that much? Maybe not, but at a time with so much uncertainty, it is always helpful to have the latest update. The other thing the MTFS does, it's an important part now of the revised budget process that was introduced in the Parliament a few years ago. So the MTFS is not only a public statement of what's going on in the public finances, it helps inform all the parliamentary committees when they do their pre-budget scrutiny work and look at the key issues for the budgets for their remit areas. They would normally be drawing on MTFS Outlook and the key messages in that. So it is trickier in an election year, and we understand why not, but it's always better to have a latest update from the government to support parliamentary scrutiny and to help the public understand ahead of the budget what some of the key challenges and pressures are.
Okay, great. Thanks, Eleanor. So there's a question I'll maybe take on the weakening economic outlook in Scotland, so what's driving it, and then are we facing similar challenges as in the rest of the UK? So, I mean, there's a couple of things to that. I think in terms of kind of any changes in the economic outlook since January, I mean, the key thing that's happened there has been the instability in the global economy, and then how that feeds through to the Scottish economy. And I think in most of our work that we do when we look at typically global economy outcomes, unless we tend not to see a huge difference between the kind of impacts of global shocks on Scotland relative to the rest of the UK. There are some exceptions to that, whether it be in particular sectors of the Scottish economy that might be more exposed, or it would take more of a broader opportunity from it. But in general, what we typically see is that the Scottish economy tracks the UK, broadly speaking, when we have these shocks. I think the broader point, which I think is about the kind of longer term performance of the economy, I think there's probably a couple of things I would say there. So first of all, at a really macro level, what we are consistently seeing, and you saw this through Eleanor's chart on living standards, is just exceptionally weak growth in the Scottish and the UK economies over a considerable period of time. And we've all rehearsed the arguments around that. So it's the weak productivity growth, it's the shifting structure, particularly in Scotland, of the demographics, so the ageing of the population, are all the kind of long-term drivers that we've had tried to solve from a policy perspective. I mean, there are some really interesting, more specific things which I think are something that we look at. So things like the work among young people and inactivity, and the recent work of the Melbourne Review looking at the trends into inactivity, disability prevalence as well. These are all factors that potentially have a harm on the long-term potential of the UK and Scottish economies. We obviously have the particular issue in Scotland, which we've highlighted before, around oil and gas and the transition from oil and gas into renewables. And on the one hand, there's huge potential for the Scottish economy in the long term around renewables and the green economy, but we also know that historically, one of the key reasons that Scotland has done well relative to the rest of the UK, particularly in high value jobs, is because of the economic activity that's created in the northeast in Aberdeen. And as that continues to go through the transition, that has a disproportionate impact on the Scottish outcome, the Scottish economy relative to the rest of the UK. So I think there's lots of different factors going on, but I think our broad assessment is that when we look through the kind of the immediate kind of uncertainties, that we've just got the Scottish economy pretty much tracking on, relatively resilient, but at a step lower down than where it would have been, particularly in the period up to the financial crisis. And that's, I guess, one of the big policy questions for the current Parliament, the new Parliament, is how do we turn around that relative performance in the economy? Because that's crucial to earnings and employment, which in turn generate tax revenues, which in turn help support public spending. There's a particular question here, if that's okay, Eleanor, around just the gap between resource spending plans and estimated receipts. And maybe just want to explain just about how the government can almost have to balance the budget, but maybe just explain, that whole trend that we see being talking about the government having a fiscal gap or a black hole and things like that. And maybe just walk people through what that actually means and what it doesn't mean.
Yeah, thanks, Graham. So the whole budget gap thing is quite tricky because you see figures, we project funding, the Scottish Government shows what spending might look like on its current trajectories, and then you see these figures of budget gap, and then every year we get to the budget, and the budget always balances because the budget has to balance. That's part of the process. The Scottish Government can't introduce an unbalanced budget. And so everyone says, where did the gap go? And effectively, when we were talking about those efficiency savings and so on, that what happens is that the allocations of spending are not as high as might have been implied by all those trajectories of spending. And it's not, but it's not really evident just from those surface level figures what's going on underneath and what's having to happen, and what course is having to happen is that services are having to find ways to save money and make reductions. And so those efficiency plans are a big part of this. It's not a black hole, right? There isn't a black hole, but it's a big part of this spending pressure gap that's having to be plugged. So in terms of 27, 28, I'm not sure I can give you a precise number because it's we know that there's this additional money in 26, 27. We've yet to see how the government plans to use the reserve, use the resource borrowing potentially to cover the income tax reconciliation. What it had set out plans at the previous budget around use of Crown estate revenues. It might want to change the profile of that, particularly given the capital differences. So there's quite a number of moving parts that the government will want to revisit in order to decide how it wants to manage this. So I guess we could do a raw number, I don't know it, of what it might look like today, but that wouldn't really be meaningful because that's before any kind of sensible looking at how it's going to be managed across years.
Okay, great. Thanks, Eleanor. So there's a question there about how does the current tax and spending policy align with helping Scotland's um, economy grow? So, I mean, what we want to do is, I mean, we try and flip the question around a bit because I think there is a really interesting thing in there about how the economy, leads through to fiscal outcomes, and then the importance, I think, of exactly the question there about how well does current and tax and spending policy align to that. So we wouldn't comment on whether we think it's a good or bad idea as a particular policy, but I think one of the really important things that Eleanor highlighted was this idea of this kind of tax-based performance gap and how this comes around. And there's lots of debates about Laffer curves and behavioural changes like that, which are all interesting, and I can understand why they're interesting both from a philosophical point of view and also a political point of view. But the numbers we're talking about in that context are typically quite limited. So we would, the additional penny in the top rate of tax, we would think that a static might raise about 50 million. I think our post-behavioural forecast is only about 8 million. So strong behavioural effects, but it's 8 million in a budget of 60 billion. So it's relatively small in the overall context. But I think the point that Eleanor was highlighting around the tax-based performance gap is really interesting, and I think it's one of the big things that we highlighted as being something really important for the new government and new parliament to really think about, where essentially what we're seeing is the government are raising more money than they would have done without tax devolution and without taking on responsibility for income tax and setting policy. They're just not raising as much as they would like, and that gap of about 888 million in 24-25 is essentially the difference between what government would hope to have raised if we had just been tracking economic performance and tax-based performance in the same as the rest of the UK. So what that shows is the importance of, I guess, the premise of the question about just ensuring that everything is targeted about supporting economic growth, because that's £888 million that you would like to get some of it back over time to help support public services. But if that changes over time and widens, then that's again potentially an opportunity cost of resources that haven't been collected. Of course, what we don't know is what's the ultimate source of that. So it could be behavioural change in there. Some of it could be factors that are completely outside the control of the Scottish government. They could be linked to the oil and gas in the northeast, where the government has got relatively limited responsibilities. It could be something completely different that the government have no control over. But if you want devolution, if you want to take on responsibility for these powers, then it comes with the risk, and you have to manage that risk. So it is, I think, a really important, again, thing for the Parliament in the next few years, just to really understand about the nature of that relatively weaker economic performance and what can be done to try and turn that around. What I would do is, there's a question, maybe Eleanor, you might want to start on it, but I might throw it over to David about the forecast evaluation report and the kind of largest sources of error and variation we had in our income tax forecast. Eleanor, do you want to do them in general first, and then we can hand over to David?
I'm absolutely happy to, and I'd had the same thought of throwing it to David. In our report, there's a chart on page 16, figure 3.3, which shows the main components of the error in Scottish income tax. And interestingly, what you see is our net error was 209 million. We over forecast by, but in fact we under forecast on a couple of areas, and then we have this large category of other error, which kind of leaves us with the net figure, and it's quite difficult with the data we have to unpack all of that. So there's a component from higher earnings and employment growth. There's a component from real-time information from the previous year growth, but there's this 500 million or so of other error, and I'm going to let David say something about that.
Okay, thank you. I think the important thing to emphasize at the start is it's really quite a small forecasting error in the context of these things. What we found is that at the top end of the income distribution, so advanced and top rate payers, the revenues from that group were a little bit below what we expected in our forecasts. And then the question is, how should we interpret that? What does that mean? But I'd be very cautious about over-interpreting that. What we've seen and we've published several times in the past is that the income of that group is just very variable from one year to the next. On the one hand, if you're looking at a sort of a median earner whose earnings might just go up with a pay award once a year of 3 or 4% or whatever. But when you're at the top end of the distribution, you get things like bonuses, much larger, much more variable incomes. So their incomes are just inherently more volatile. And of course, if we looked over the course of several years, we might see the tax revenues from that group going up and down quite a bit. So this year, lower revenues amongst top rate taxpayers was part of the explanation for our forecast error. But I don't think we can go too far in interpreting sort of what that means for what's going on there.
Great, excellent. There's a specific question about £2 fare cap for buses and whether it's in spending plans. I think there's a general point in there as well. Is that again? This is where for people, this is a pilot, as a trial. There's some of it being run across parts of the Highlands, with the commitment that this will be rolled out more generally across Scotland over the course of the Parliament. These are one of the ones where governments have made commitments on manifestos to do this sort of thing. The budget time will be when this all gets set out in the detail and fully costed and then put into that. And again, one of the things we said in the run up to the election was that if you're going to come forward with new proposals, new ideas, with more spending commitments, if you look at that chart that Eleanor had about a really flat funding outlook, then that would also mean that there'd be an opportunity cost somewhere else in the system where you'd have to find the additional resource for that. So that will be the budget time for that. There's a question there, Eleanor, just about changing demographics, aging population and cost of living pressures, etc. And that's all going to come into future budgets. Do you want to say something briefly about that, and particularly our fiscal sustainability work?
Yeah, surely. So, I mean, the interesting thing with the demographic point is when we publish reports looking in the long term at the impact on health and so on. But actually, I think probably we're all used to seeing reports talking about demographics and looking decades ahead and the challenges. But actually, you can already see the impact of the demographic challenges even within the next 5 years. It's not a long-term future issue; it's a now issue. The particular challenge around the demographics in Scotland versus England. So if you look long term on the population estimates, you see that Scotland faces a pressure more quickly, and then to some extent England catches up, if you can say catches up, on a demographic pressure later on down the line. And so these things are already hitting, and part of budget gap, part of efficient needs for efficiencies and so on is really being driven by what's going on with demographics and in terms of population, and also relative health, population health in Scotland relative to England, and then the other factors, but those are two of the really biggest ones.
Okay, great, thanks. So a question about trends in employment. And the growth in earnings and things, yeah. And I think so. I mean, broadly speaking, I think we've covered pretty much the core components about what we're observing about what's happening in the labour market. So, in the sense of earnings continuing to rise, but inflation essentially eroding the real terms value of that, but in turn leading to pressures and higher pay awards. Employment holding up relatively high. There's a question about the quality of that employment, which again comes back to earnings, and some of the more longer term structural changes we're seeing in the employment market around people working for longer toward the tail end of their working life, but also some interesting issues around inactivity at the start of people's working lives, which is a broader thing right across the UK. So that's pretty much, I think, what we're seeing in the employment bit. And that gets into the question about the perceptions and the cost of living crisis and whether or not kind of real incomes are still rising or not. And I guess the point is that higher inflation means that eats into that real disposable income. But Eleanor made a really important point, which is what we're doing here is looking at the average. But if you look at particularly the lower end of the income distribution, that's where the particular pressures are coming in, and the cost of living crisis is particularly high when you're thinking about energy costs and food costs and transport costs have a disproportionate impact at that end. There's maybe just time for one final question, Eleanor, to you, just around how can the government use positive reconciliations in one year to help manage negative reconciliations in the other?
Okay. So there is this, we've mentioned several times on this call, this thing called the Scotland Reserve. And the thing I have forgotten, and I'm going to ask Claire to say, is how much is that at the moment?
So it goes up in line with inflation each year. It was 700 million, but it's over 700 million now. I can't remember the exact figure off the top of my head.
No. Okay, that I could remember 700 million, and I knew it was indexed. Anyway, it was so it's well under $1 billion. Call it that, and that is Scottish Government's main flexibility to manage across years. So it's not large. Given the overall budget, we're talking well over 50 billion. You're talking about really very small percentage that you can have and put in the reserve. So if you get a positive reconciliation, you get a windfall money, you can put it in the reserve to manage it across years, but then you also use the reserve to manage, for instance, underspending at the end of the year. If you need to carry that forward, you want to carry that forward into a future year. And you also, you might want to use the reserve in a very planned way to decide to put some money aside for something. So the overall size of the reserve is really very small to allow the management. There are other things the government can do. On the capital side, it can change the profile of its plans for capital borrowing potentially and help smooth things that way. But again, there are limits, annual and aggregate limits on capital borrowing. There are Crown estate revenues we keep mentioning. That's another pot of money that the government can choose when it draws that down. So it had set out plans to draw down some Crown estate money in each year. So at the budget time, so it can maybe change the profile of that and not draw down so much so early. But it depends what has been planned, what flexibility that gives the government in a year where it has a positive reconciliation. So I think all this will come into play with the next review of the fiscal framework again. There'll be discussion about these limits and the tools and the scope to manage all of these risks. It's, as Graham said, you have to take the risks if you're going to take the responsibility, but you need the tools to manage them.
Great, thanks, Eleanor. And then just one final question just around volatility of bonus pays and things like that. And yeah, so what we try and forecast is non-savings, non-dividend income, which includes essentially everything from employment, pensions, self-employment income. There are some things in that which are relatively easier, I'll say easier in inverted commas, to forecast, particularly things that are around to salaries and the like. The bits that are the most difficult, as David said, are things that are particularly the top end of the income distribution, so income from self-employment and bonuses, etc. And we have the added kind of sting in the tail in our framework in that it's not just in terms of reconciliations and the income tax net position. It's not just about how these are moving in Scotland, it's how they're moving in the rest of the UK. So things like bonuses, perhaps less of an issue in Scotland relative to, say, the City of London, where there's a much bigger bonus culture, and that has some volatility in the data there. So all the joys of what we have to try and forecast and work through. So we managed to get through all the questions, and it also gives us 2 minutes back in everyone's diary, which is always, I think, good etiquette to do. So can I just thank Eleanor? Thank you so much for walking us through the presentation, and David and Claire for helping us with the questions. Thanks to everyone for joining us. If you are interested in what we do in keeping up to speed with our activities, we've published our new insights, where we put regular short articles, information articles about recent data or recent updates or explainers about what we're doing. The current trajectory of the fiscal outlook will be is that the government will obviously be coming back and giving updates to Parliament in the coming weeks as Parliament returns, particularly around the programme for government. We'll then have the UK government budget in October, and then the Scottish budget will follow after that. So we'll be doing our usual webinars and commentary around the